Hi, welcome to Monday Night Live. I'm Aaron with Ape Properties. I'm excited to have Cal Ewing on this evening. He's from Calgary in Alberta, and I met Cal just about a year ago, I guess, in Mike Wolf's group, and we've stayed in contact and quite regularly. And just great to have you on here. And Cal's been started investing, I think, in the U.S. in 2007, but I'll
I
let
think
him
it
in
was 8 or 9
8 or 9. Yeah.
is when I actually bought a house.
Oh, okay.
Yeah.
And yeah, you have 49th Parallel Properties, I think. And
Yep. 49th Parallel Properties Limited is the company, which
oh,
is the Canada-US border meridian for most of it,
right.
at least in the West. Yeah.
And you also, is it Real Estate Wealth Creators? Is a Facebook group as well?
Yes. Real Estate Wealth Creators Facebook group. You got it. Yeah.
Oh, great.
Well, thanks for having me here, Aaron. It's awesome to be here.
Yeah. Well, thanks for coming in. Yeah. When you got started, then how did you get started in the US?
Well, the first thing that got me started was Rich Dad Poor Dad. I was actually in a network marketing group, as so many people have done. And I was going to college or university, I guess, at U of C. And my cousins were doing this network marketing and they were doing pretty good at it. So I joined. And a lot of the presentations that they had quotes from Robert Kiyosaki and Rich Dad Poor Dad. And so I ended up listening to the audiobook. And I was just like, oh my gosh, real estate is where it's at. This is so much better than network marketing. And so after listening to that book, I just got all gung ho and actually signed up for Robert Kiyosaki's one of his real estate training programs, and I thought it was amazing. But then I realized that most of the training was U.S. based, and I tried to do some of the strategies here in Canada and realized that some of them you can't even do here because the laws are just so different or the market's different and that kind of thing. And so I was getting really frustrated because I felt like I knew all this excellent US investing information, but I lived in Canada. And that's when I actually met Mike Wolf, who you mentioned, who's also from Calgary. And in 2009, he was investing for himself down in Las Vegas. He'd been investing in Calgary for quite a while and then moved down to Vegas. And he had so many people that were asking him as Canadians how to invest in the States that he actually started teaching people. And so he'd take people down to Vegas. And this was right at the time when the market crashed. There was just a huge wave of foreclosures, as you probably remember. And Las Vegas was the first market to really crash. And so Mike had built this team. He had realtors that were going to the foreclosure auctions every day and bidding on properties. And so I went and I had some money partners that we joined up and we went down and learned how to buy from the foreclosure auctions through Mike and his team. And it was really hands off, which at that point was great because I would have made some huge mistakes, I'm sure, because I really didn't know anything. But his team, they got a property for us in Vegas, and we ended up doing some light remodels on it and sold it and made a quick profit in a few months. And we all thought that was pretty great considering we were from up here in Canada and didn't know what we were doing. And then from there, he also started growing his team in Arizona, in Phoenix, because Phoenix crashed about a year later. And so we bought a rental there and kept that one for about 2 years. And right at the bottom of the market when things were starting to get peak back up again, because the market was tanking. And in about 2011, it started going back up. And so we did really great on that property. So at that point, I was completely hooked on U.S. real estate, and I've never looked back since. So,
Oh, that's awesome.
yeah. Mm-hmm.
I know you were in the Texas market as well for a while.
Yeah. So most of the real estate I've been doing has been in Texas, and I've done everything from wholesaling to fix and flips, had some rentals, bought at the tax foreclosure auctions. So a whole bunch of stuff in mainly Houston.
Oh, okay.
Yeah.
And were you down there then through all the hurricane and all that, everything? Were you investing through all that stuff?
Yeah. So I guess every investor, they kind of they cut their teeth or go through the school of hard knocks one way or another. And for me, it was Hurricane Harvey. So I had just learned how to wholesale deals, and I was also geared up to fix and flip. And so I was making offers and nothing stuck. And I was just getting outbid. And then finally I had a deal accepted And then it kind of came in a wave because then I had another deal accepted. And this is just in 2017 before the hurricane. And so ended up doing 2 fix and flips. We had a hard money loan on each one. And the one flip that we did, we had our open house date was scheduled for the Sunday that Hurricane Harvey showed up. And that house flooded big time. And so all of that hard work that our contractors did went down the drain, literally. And luckily we had flood insurance on that house. And then the other one, we were about half through the remodel on the other one, and it flooded even higher, like 8 feet of water. And so we had flood insurance, which is great. But that was my first real challenge as a real estate investor. But, you get through it and you figure out ways to solve the problems and move on. So,
Right. Well, at least you had flood insurance anyway.
Yeah, thank goodness. And you know what? I don't know if it was up to me at that point, I might not have even thought to do it. Just, being up here, there's not a lot of flooding. But the hard money lenders, thank goodness, they required flood insurance. And so we had that on our property. So you learn, right? And it's good to have, lenders sometimes to vet your deals to make sure you're actually not missing something, right? So, yeah.
Yeah, because with the hard money lenders, they will obviously assess the property as well.
Yeah, they're like an extra set of eyes. So if your lender turns you down,
Right.
well, then there might be a problem, something you missed, or maybe something you can learn from them. So,
right.
Yeah.
And are you fast forward now? You're doing the investing in notes and non-performing notes.
Yeah. So I've moved around for different strategies, just trying to figure out the best niche for me. As you're well aware, being in Canada and running a real estate investment company and finding deals and managing teams in another country, it can be a challenge, right? And as also markets change. So one strategy will work for a while and then things change. And so you have to pivot a lot. And so I was wholesaling a lot of houses in Houston right after the Hurricane Harvey, because I can't remember the number, but there are thousands of houses that flooded. And so we had just a wave of suddenly motivated sellers. And some of these were in extremely fancy neighborhoods. So not your typical fixer upper that you'd find, but these were nice neighborhoods that flooded when they weren't supposed to, because just this unprecedented flooding that had never happened before. So there was huge opportunity for deals into wholesale. And then once that inventory kind of got used up and the market started going up again all over the US, right? This is in the last 3 years, just appreciation has gone crazy. And also wholesaling in general has become more popular with podcasts and the internet and YouTube. So we just found it really competitive. And so I've been looking for a niche that to kind of replace that, because I just kind of got burned out working too hard and having to rely on people on the ground and that kind of thing. And so I found real estate notes, mortgage note investing. And I really like the idea of, especially from afar when investing from abroad, is being the bank instead of the owner. And the reason for that is when you're the bank and you're basically, what we're doing is buying mortgages from banks. And these are mortgages typically that the banks don't want because of the fact that the borrowers are not performing at the moment. And so what non-performing means is they're at least 90 days behind on their payments. And so most banks, their goal is they want to lend money and earn interest, right? They don't want to be foreclosing or taking houses back and then listing them and all of that. They just want to lend money and earn interest, right? So they'll sell what's called non-performing mortgage notes for pennies on the dollar. So 40 cents on the dollar, 50 cents on the dollar, something like that usually. And so you can buy these mortgage notes, you become the bank, and then the number one goal is to rehab the borrower. So get the borrower back on track and figure out what their issue is. Maybe they were recently laid off, especially with COVID. Maybe they, were laid off or something like that, and they couldn't go to work or they couldn't work as much. But now that that's all behind us, maybe they're working again and they got their income back, but now they're a year behind on payments and they're trying to get out of this hole and they just can't. And so the bank might be trying to foreclose, but if we come in as the lender and we can be more flexible because we're a small company, we can deal with them on a one-on-one basis and work out a deal to get them performing again and see what we can do to get them on track again so they don't lose their house. And then if you think about the numbers, let's just say there's a $100,000 mortgage, say, and we buy it for $50,000 from the bank, right? So we're at 50 cents on the dollar on the mortgage that we buy. Well, if we can get them performing again, and say they were paying 5% interest on $100,000, well, if we bought it at $50,000, then that's like 10% interest, right? It doubles the interest rate, and so that's great cash flow. And now we've got basically like a little oil well that's performing every month, but we don't have to worry about repairs and maintenance like most landlords do because we're just the lender. So it's a lot more hands off. And then the other thing is if they can't get back to paying again, then you have the ability to foreclose or do like a cash for keys and take the property back, and just have them deed the property back. And now we've got a great property that we can fix and flip or rent out or do a rent to own. Like there's so many different strategies, or you can just sell it off, and get a nice paycheck over a short period of time. So I like that a lot.
Yeah.
Yeah.
Yeah, it sounds interesting. And with the notes, can you buy single notes, or do you have to buy like a whole package? Like, or
it all depends. Yeah. So, I mean, there's thousands and thousands of banks across the US. And so depending on when you reach out to them, it's basically just marketing constantly to banks and asset managers and just growing a network. So you'll find some banks or asset managers from banks that have a whole pool of notes and they're selling them all off in a chunk. So you got to buy every one of them. And they'll only take offers if you're willing to buy everything they have. Other times you can pick and choose. You can make offers on individual ones that you want, or maybe buy a small group out of the whole big group, so that it can be flexible. It just depends on what that bank is looking for.
Right. And then I don't know if there was a portfolio of them and there's a few that can you pick and choose, or if they say, no, you got to buy the whole thing. What do you do with those notes when you get them that you don't?
Yeah, well, good question. So, I mean, I haven't got to that part where I've been able to buy pools, but I know that gives you more leverage. So if you can go to a bank and say, look, we want these 4 or 5 or however many good notes, I can see you have this other kind of junky stuff on your portfolio as well. And if you get rid of that, I know it's going to make your books look better. So, maybe we could do a deal where we buy those crappy notes from you for, $100 or something like that, or we'll pay the price you're asking for the good notes, but we want a huge discount on those bad notes or the ones that are less desirable. And then you could either just leave them and write them off, take it as a loss, tax write-off, but you got the notes you're looking for that are paying and performing. Or maybe you can wholesale those notes to another investor. Maybe they want to foreclose and then do a full remodel on them or something. So you can always sell those off. If you get them at a huge discount, you can still sell them at a discount to another investor. So there's a lot of flexibility there for sure. Yeah.
Yeah. Well, that's cool. Is there a certain, I know with each state varies obviously, but if there's landlord friendly states, and they all vary, would it be as far as foreclosing? I know that there's different states would be different. So would you only get notes in certain states then, like since you can pick and choose?
Yeah, so that's the one thing about this strategy is you're looking essentially at notes all over the US, because a lot of these lenders, obviously they're going to lend in multiple states, right? And so like, for example, this past week, I was looking at notes in Nevada, Arizona, Indiana, Michigan, like they're just all over the map. Wow. And so there's certain states, though, that are called judicial foreclosure states. And what that means is they require the foreclosure to go through the court system. And it's kind of like here in Canada. So it can take a really long time in certain states to go through that process. So states like New York and New Jersey, Massachusetts, a lot of the more eastern seaboard states, they can take a really long time to foreclose, and that's usually not very desirable for your strategy, right? You want to get paid and get in and out rather quickly. And so we just avoid that stuff unless it's just a smoking deal or something like that. But there's states like Texas, for example, that are what are called non-judicial foreclosure states. And what that means is they can foreclose on, like a bank can foreclose on a borrower without having to go through the court system. They just have to follow some procedures, and then they would hire it's called a trustee to go to the foreclosure auction and just foreclose and sell off the property. So it can be done in Texas. It's one of the shortest states, and that can be done in just a few months. So, yeah. So you just got to know how long it takes in each state and what the process is. Be prepared for that.
Right. And then what, do you know what percentage that you would be able to get back on a payment plan?
Well,
Approximately, I guess it would
it
vary.
depends. So one of the good things is when you're doing your due diligence on notes, they'll usually, well, they will. You would request the payment history on that mortgage. Okay, so they're going to tell you, they'll show you when the last payments were made by that borrower, and sometimes if you can see signs that they're trying to pay, so let's say they haven't paid in a year, or let's say they're a year behind on their mortgage, but they've made a payment here and there, maybe a couple payments here and there. Maybe they've made a double payment 1 month and nothing the next. It shows that they're trying, right? It shows that they're trying to save their house. They want to stay, but maybe they just can't. And so those are the ones that you would want to target as something that you can get them performing and paying again. And that's your long-term cash flow strategy. So on those, you can make anywhere, between, I guess it depends how you buy it, but $200 a month all the way to up to $1,000, I guess. Really, it depends on the note, but that would be your monthly income passive thing.
Right.
And then other notes, you're going to see where there's been no payment history. Maybe there's 2 years of nothing, and maybe the house is even vacant. And in those situations, you'd want to be, running your numbers as foreclosing, and then what you could sell that property off for from the foreclosure sale. So it's kind of two different strategies depending on what you're seeing from the borrower.
Right.
If that
So
makes
when
sense.
you're looking at it as well, doing your due diligence, would you probably be looking opposite of having a lot of equity in the property? You would kind of want it even opposite or very little equity, or?
Yeah, it's actually different or opposite of what you'd think, right? Because as you know, Aaron, as a real estate investor, you're always looking for equity, right? Like you're looking for, the 70% rule or something like that for a fix and flip. You want properties with equity. But the banks will, if there's a lot of equity on the property, number one, the banks also know it, right? And so they're not willing to go as deep a discount, because if you do foreclose, if there's a ton of equity in the property, they know that you're going to get the full loan amount paid off, right, at the
Right.
foreclosure sale. Whereas if the borrower is underwater, which means that they owe at or more than is the property value. So let's just say the house is worth 150,000, and let's say that they owe 170,000, say. Okay, so they're underwater. Well, in that case, you can get way steeper discounts from the lenders because there is no equity. And so those are the kind of situations you can buy at, 30, 40 cents on the dollar. And then it doesn't matter if it's underwater, because you're only in for,
Right.
let's say it's $100,000 mortgage. You're only in for 30,000 and the house is worth 100. Well, there's tons of, it's not really equity, but there's tons of protection there to make sure you get your investment back, even if you foreclose. I hope that made sense.
Yeah. Yeah, it
Okay.
did.
Yeah.
And
Yeah.
I guess same with, if you get them back performing again, then it would just be that same exit strategy. If they stopped for whatever reason,
Yep.
then you would just have to go through that foreclosure probably process, or cash for keys you mentioned, and that would
Yeah.
just be
Cash for keys is good because sometimes you can help a borrower avoid foreclosure, because that's a huge credit hit for them. That's a 7-year hit and makes it really hard for them moving forward. So if you can maybe pay them, move out money to get a deposit on a rental property to rent and move into, in exchange for that property, now you're the owner. And if there is equity there, then you can basically sell that for full equity, right? Because you're now the owner of the property, just as you would if you bought it in any other way. But that's not always negotiable. It depends on the borrower and if you can reach out to them, if they'll respond to you and that kind of thing. So,
right.
yeah.
Well, that's pretty interesting. And then
Mm-hmm.
how would what are some of the biggest mistakes that a new person could make getting into notes? Just not.
Well, I think number one would be just your due diligence. So a couple things you need. Number one, you need to get a as is value assessment, right? So you want to know what this asset, the collateral for that note, is worth in its current condition. Okay. So that's typically done by ordering a broker price opinion or a BPO. Okay. So if you're just going on Zillow and using the Zillow value or something like that, that would be a huge mistake, because obviously if the value's off and you pay too much for that note and then you have to foreclose, And it basically, as the borrower or as the lender, you can only foreclose for what is owed to you, right? But if the property's not worth that much, then you're losing your money, right? So that's number one. Number two would be just not vetting the loan documents and the title history of the property. So maybe there's errors, things like that could happen a lot of times where suddenly you realize that you weren't actually, there's a breach in the chain of title or the assignments from one lender to the next. There's errors. Not having insurance on the property. So let's say the borrower didn't have insurance and then it burns down. So it's pretty basic stuff. It's very similar to when you're buying any property. But that's where there's room for error for sure if you're new.
Right. Mm-hmm. And if anyone, how would I get started in just learning about it before kind of going and taking?
Yeah, well, there's lots of training online. There's a lot of people out there that train mortgage notes. There's lots of videos online. So I would just Google mortgage note investing. Like I don't really teach it, but there's enough resources out there. I think you could get your feet wet with just free online information. And then there's also people that would teach it. You could probably hire a mentor and work under them or get some one-on-one training just to get yourself started. So yeah, it's not very common. And I think with the way the market's going right now, I mean, we've seen a lot of equity in the last 2 years for a lot of borrowers. And so a lot of them are not willing to lose their house or they know that they can sell their property off. But over time here, I think we're already seeing prices all across the US go down just because of the raise in interest rates. And so I think we're going to see a lot more situations where, especially because of the high inflation, the cost of groceries and gas, there's going to be a lot more people defaulting on their mortgages. And so there's going to be a lot more opportunity to buy non-performing notes. So I'm excited from that perspective for more opportunity in that space.
Right. Mm-hmm. And like you've mentioned before, I guess the first thing that you would hope for or want would be to get them back performing. And then you would have that cash flow and they would be a win-win kind of for everyone.
Yeah, like it depends on what your tastes are as an investor, right? So I'm at the place in my life and career where I really want to get that reoccurring cash flow, that monthly income, so that if I want to retire or take a year off and travel or something, if you've got enough paying notes, then that's just money coming into your bank account month after month, right? With little work. But there's other people that maybe they're in more of a wealth building strategy or phase where they want to just get cash. And so that's where you would pursue the foreclosure deals, right? You'd buy ones that you could probably foreclose on quickly, get paid out, 15, 20, 30, 50, whatever, thousand, and then buy your next note. So you can build cash that way. But I'm kind of at the phase where I prefer the reoccurring passive income. So.
Right. And I guess like you said, though, when you're doing your due diligence, you can kind of find out where, if they've been making some payments and they might get back on track. And if they haven't made a payment, then you can, if you wanted to target the foreclosure strategy, then.
And you never know 100%. Yeah. And you can also buy performing notes as well. So you don't just have to buy non-performing stuff, but a lot of times the banks will sell those at a higher price because they're already performing. But if you've got the cash and you just want a nice return, then buying performing notes is a great investment strategy too. And also, you can also sell your notes to other people that are looking for performing assets. So you could buy it non-performing at a really good discount, get them performing for a year, and then sell that off to a note investor or a hedge fund that's buying notes. And sometimes they'll pay, 80 cents on the dollar for a performing note. And if you bought it at 40, then that's a pretty great, year's worth of income. Plus you've been getting that monthly income for the full year that you've been getting the borrower back on track. So that's a good strategy as well.
Right. Mm-hmm. All right. Well, that's awesome. That's a lot of information. And is there anything else that you'd like to share about the note and that you found?
Well, that, I guess the only other thing, which I don't want to go down a deep tunnel with this, but buying houses and then owner financing is another way of you can basically create your own notes. So if there's any of you out there that are looking for deals, a really great strategy instead of just keeping a rental property or doing a rent to own is actually selling the house to someone that can't quite qualify for a mortgage with a traditional bank selling the house, getting a 10, 20% down payment from that borrower, and then you've created your own note. So you don't necessarily have to be buying from banks. If you can buy houses at a discount and then owner finance them, that's another great strategy. And then you're a note holder as well. And that's another thing I like to do. So,
Right.
mm-hmm.
Like a subject to type situation.
Yeah, subject twos are perfect for that. So yeah, you buy a property that's in pre-foreclosure, and negotiate with the seller to take over their mortgage payments, and then you turn around and sell that house. And so then you're the lender, your buyer borrower pays you every month, and then you turn around and pay the underlying seller's mortgage. It gets confusing, but you can create cash flow that way too. And that's probably a topic for a full call.
Yeah.
but I love that strategy too. So
Right.
yeah. Mm-hmm.
Yeah, I just love real estate for that reason. That there's
Me too.
a lot of different strategies that you can do.
I love it. And yeah, there's so many ways you can do it. And the more you're in the industry, the more fun you can have, and the more strategies you can try and find. So it's great.
Yeah, I think knowing a little bit about them as well, then when the time comes, like you mentioned at the very beginning, that if the market changes and you have to pivot maybe to a different strategy that makes more sense,
and they all build on each other, right? So everything you learn about, being a landlord, for example, it's gonna build on being rent to owner or owner finance, or like they all just grow on each other, and your skills transfer over. So
right.
Mm-hmm.
All right. Well, thanks for coming on tonight. I appreciate it. It was a great call. Great to see you. And
you as well.
Is that the best email then? I guess at the bottom there, is that the best way to get a hold of you? Or
I'm not seeing it, but it's just at the bottom there. Okay, Cal at calewing.com. Yep,
that's probably the
easiest
best way.
Okay. You betcha. Yeah, and then I guess if you don't mind me plugging the Facebook group, Real Estate Wealth Creators, and it's very similar, I think, to Aaron, what you've got going on. We're just trying to provide value for real estate investors, and we have both Canadian and US content on ours, and so it'd be great to grow both of our networks. And if this does get shared in my group, you should go ahead and join Aaron's group as well. So join forces and grow our networks, right? Help each other out.
Yeah, for sure. Okay. All right. Okay. Thanks again.
All right, Aaron. Thanks a lot. Appreciate it.